Welcome back, investors. Ticker Time News. I'm Adam. And Nvidia, they posted their Q3 earnings today, and their non-GAAP EPS of 58 cents missed by 12 cents. But revenue came in at $5.93 billion, down 16.5% year over year. But that still beat by $110 million. Now, the non-GAAP gross margin came in at 56.1%. And Q4 22 guidance revenue is expected to be about $6 billion, plus or minus about 2%, versus the expectation of $6.1 billion. Now, let's go a little bit deeper here on the numbers from Nvidia, and then we'll talk about the stock chart as well. Nvidia has a U.S. government problem. The restrictions that were placed on Nvidia and other semiconductor firms in the U.S. on the sale for Nvidia specifically on some of their semiconductor technologies to China impacted the company's Q3 revenue, and it will continue to weigh on sales in the near and medium term until this gets figured out. And I'm sure as Nvidia comes up with ways to circumvent these restrictions, the U.S. government will find new restrictions to put in place. So this may become a cat and mouse game between Nvidia and the U.S. government, and then, of course, China. Now, Nvidia's CFO said the new restrictions really impacted the company's A100 and new H100 data center graphic processors. But Nvidia's CFO also said that those products were largely offset by sales of alternative products into China. Now, that's something that we knew. We actually talked about that several weeks ago when that news came out. Now, Nvidia saw a big decline in its gaming business, and this is as to be expected with the crypto crash and with more people going into the office to work. Less people are at home, especially the kids who are now back in school, at home playing those video games and using all the different consoles that use Nvidia within their gaming. Now, gaming sales fell 51% year over year to $1.57 billion. Nvidia is still dealing with increased inventory levels, macroeconomic conditions worsening, and COVID lockdowns in China weighing on consumer demand. Now, one area, I can't just talk about the negatives without talking about something positive. One area that is shining brightly for Nvidia is its data center business. It's going strong, especially customers looking for artificial intelligence, AI, and building their own, of course, outside of Nvidia, companies wanting Nvidia's data centers to build their own artificial intelligence or AI type of setup. That demand is surging higher and higher for Nvidia. So that is a good place to be. I say it about Amazon. Amazon, it's not really about the retail anymore. It's about the data center. And that will be true for Alphabet and for any other company that wants to set up, run, manage data centers. And they're going to need companies like Nvidia for those data centers. So that is a strong demand for Nvidia. Gaming, unfortunately, I think will just continue to drop off. I don't see a pickup in that. Even the holidays, there's plenty of inventory out there already. So I don't even think that's going to make a material difference for Nvidia. Now, on the chart for Nvidia, we had Nvidia dip down into our buy box that we adjusted lower, and we had it set for $125 a share or less. Nvidia got into that buy box for a couple of weeks. It was nice to have it down there, but since then, its turnaround on October the 13th, it's been pushing higher. Now, we do have a bit of a lonely candle atop here from yesterday, because today we did drop back down 4.5%, going into earnings. But Nvidia is up 1.6, almost 1.7% in the after hours. So that puts it basically back where it opened today. Interesting, huh? Now, there is a sticky point for Nvidia right around the $163 a share. It's really sticky. It will be sticky for Nvidia, but who knows? If everything lines up, Nvidia could gap over that by the open of tomorrow. Then we really need to pay attention to, and let me get my highlighter, the upper end of the weekly expected move, which is at 178. We've got a few things happening here. We've got the weekly expected move at 178. And then above that, we've got sticky resistance at 180. And the third sticky business up here for resistance is the 200-day moving average. That is currently sitting at 181. So we go from 178 to 181 as a zone of very nasty resistance for Nvidia, okay? So keep that in mind. Anywhere between 178 and 181 is currently stiff, really strong resistance for Nvidia, all right? Now, if Nvidia decides to launch tomorrow and then profits are taken on Friday, maybe, I don't know. On the lower end of the weekly expected move is 147. There is a gap that was created right underneath that. So if Nvidia for some reason happens to break below that 147, that gap fill, Nvidia may fall quickly. Now, I think Nvidia is going through a transition time, all right? A time of transition, moving away from certain components that have been sold in China, moving away from maybe even certain gaming applications and products, and moving towards the future, AI, data centers, and so forth, everything that goes along with it. So in this transition that Nvidia is in, it's got a strong future, but it's going to get tripped up here and there along the way. So what I'm thinking is adjusting this buy box for Nvidia and bringing it back up a little bit. I'm looking over here on the volume shelf profile. Where is some interesting numbers that buyers really step in, or maybe even sellers have stepped in the past? And it looks like right here is a top which lines up with 139. I know that's still far off from where it is right now, but we do have that. And then we have an air gap here where there's really nothing until we get up to 150, okay? So what I'm going to do is I'm going to take our buy box, I'm going to adjust it, and I'm going to raise it. And I'm going to take it back up to where it sat once before. Let's see, where can I get to the middle line here? Yeah, it's a big wide buy box because it went and connected with the other end of the chart when it came back down. Okay, let's just do it this way. There we go. I'm going to take the buy box up to a minimum of 150. I think that will be a good entry level for the long term for Nvidia. Okay, I don't know why I'm playing around with this when I can just hit the settings. I always forget about this and just go in and hit 150, and that's where I want it. And the bottom of the buy box is all the way down to 110. I might just leave that there for now, make this a really big buy box. $40. I mean, that's a good chunk right there. And I'm going to slide this over so the buy box does line up with where we're at. And now the top of this buy box does go just above the weekly expected move on the lower end, that 150. So I'm going to leave it there. I know Nvidia it closed today at 159. It's up to 161.75 right now in the after hours. But even though Nvidia may have a nice green day tomorrow, if other macro factors play along tomorrow, then I don't think there's anything to worry about. I think Nvidia will come back down to the 150 area to add to your position, your long position. If that's what you're looking to do with Nvidia, I don't think it's just going to launch from here and run for a decade. No. 2023 is shaping up to be a very, very difficult year, especially the first 6 months of the year. It's going to be rough. And those macro factors will play a role with Nvidia and bring its share price down. So I feel comfortable leaving the buy box there with the top end of the buy box at 150. And I just left the lower end of the buy box at 110 because Nvidia, believe it or not, it got down nearly to 110 or just below 110. Yeah, it got down to 108.13 on the 13th of October. That was the absolute low. So if we have another downturn that takes us close to that 108 low for 2022, buy. That would be my suggestion, okay? I don't know if that's going to happen again. It could happen in the next week or two, or it could happen next year, potentially. So keep your eye out for Nvidia. Set your stock alerts. TradingView, very quick and easy to set stock alerts. A lot of platforms have them. Use them. So when a stock does break a certain point, you know that, hey, I need to open up the chart. I need to check out this stock. I need to see what it's doing. Is it just completely falling out? Or is it finding that bottom? And this is my buy point. This is when I said I would buy, and it's there. It's reached it. So set those stock alerts so you can make sure to get the stock that you want when you want it at the price that you want it. Okay? All right. Glad to see that on time today. It's awesome. And I was buying that crazy in the low 120s, 50 shares, regret not getting more. Yeah, you never know. I mean, Nvidia had been falling all year. I mean, since last year, quite frankly, back in November. Nvidia hit its high in November of 2021, and it fell October the 13th. The low for the year so far for Nvidia, there's no way that any of us could have realized that that would have been the bottom for Nvidia. It may not be the bottom for Nvidia in 2022. I mean, it looks like it could be shaping up to be, but we just still never know. We don't have that crystal ball. But yeah, I feel you, definitely. Yeah, that was interesting, wasn't it? Nvidia going down. I remember when I had the buy box up around this area before, and I got comments, no, Nvidia is never going to get that low. You never know. You just never know. And then when I put it all the way down to 125, again, it's never going to reach 125. Well, it got to 108, which was pretty great. And no, I'm not trying to rhyme. All right, so that's NVIDIA. I do want to read through the earnings call later on and dive into it a little bit deeper on a fundamental level, not just this kind of surface level. So I will be doing that. But that's NVIDIA in their earnings in the stock chart so far. And let's go talk about today, because there was something major occurred today. There was a major shift in the market today, and whether it's good or bad, it was still a major shift. Let's see here. The Fed's ultimate rate, let's get this up on the chart so everyone can see. The Fed's ultimate rate will wreck it unless there are non-gaming exports are strong. Anything consumer driven will suffer in January. It will, absolutely. And I'm not saying, and I want to put this up because this clarifies what I'm saying. I'm not saying this October 13th, 108 was the low for 2022. It could be. It looks like it could potentially be shaping up to be that way. I am saying that this potential run for Nvidia, I think it's got real big headwinds at 180. Real big headwinds at 180. I don't think it would go past 180. That would be a miracle if it did. And you're absolutely correct. This is only a short-term little bounce for Nvidia. This is not, it's going to run for the next decade, because no, it won't happen. 2023, like I said a few moments ago, is shaping up to be a rough year, especially the first 6 months of the year. Consumers are being weakened right now. They will not have money. And Walmart and Target confirmed this with what they are seeing in their earnings reports today and yesterday. It's going to be rough. Consumers are going to be penny pinching when it comes to the first half of 2023. So this is definitely not a long-term run. However, if you are looking to build out a long position on Nvidia, picking up Nvidia at the top of my buy box here at 150 or below, that'll look awesome in 5 years from now when Nvidia is, I don't know, 200 plus a share. A decade from now, what's it going to look like? I don't know. But I do think buying it sub 150 to hold long term, and again, small, tiny positions, a little bit here, a little bit there, sub 150 is not a bad idea if you believe in the company and believe in it long term. Not financial advice, just some dude on the internet sharing with you what I think. So take that, add it to your own theories, suggestions, and ideas for the company, and we can move on. Yeah, I can check in on AMD right quick. Let's pull this up. The aftermarket has closed, so I will not be able to see how they are reacting. And I did not look at AMD earlier. They've got the same structure here as Nvidia, quite frankly. They've got support down here, sub $60 a share. They've got good support down there. The character or the structure here, let me blow this up a little bit more. The structure is just not quite right here for AMD. I think they might get a little bounce because of, and I'm just adjusting the chart here to make it a little bigger. They might get a little bounce from Nvidia just to kind of ride along with them, because that usually happens when companies are so similarly in the same industry or sub industry. Resistance right here around that $79, $80 a share for AMD. There's definitely resistance there. A lot of activity around $80 a share. You can see it right here. And going back a little bit further, that same mark runs right across here. A lot of reactions around $80 a share. So I think 80 will be resistance for AMD. And obviously we saw that spinning top there yesterday, which is typically a bullish signal. So yeah, that could be a topping pattern. AMD did reconnect with its 5-day EMA today, which is great. Being 3 days off of that line is just way too extended, either upside or downside. You can see that. Okay. So, and at some point, cloud computers, yeah, let me throw this up here. And at some point, cloud and server roll over in a recession, right? At some point, it will. However, there can still be a little bit of growth with that, because even in recessions, a lot of new technologies are created, right? People are looking at older companies or old ways of doing things, and they want to innovate, and they need that technology. And Nvidia will be there to supply that technology. So sales can suffer, but they not going to drop to zero, right? So the first half of next year, it looks rough, and I could definitely see Nvidia coming down. I could see the entire market in the first half of 2023 coming back down and retesting the 2022 low, especially if we are in a dire recession and the Fed puts us in a hard landing. Those things will occur. And the switch in the market today, that happened today, you have to be prepared for it, or you're going to blow up your portfolios. And I want to get into that. That's the next thing that I want to get into, that because it was a major shift. Let's see here. Just ETFs. What Nvidia's pop about was way past while I was watching at 4:20 p.m. Okay, I'm not sure I understand what you're saying there. So was that pop just risk aversion by shorts? Now I'm connecting your two comments there together. Okay, got it. Part of Nvidia's pop, at first, it wasn't that much, about 0.9%. And then as we got closer to 8:00 p.m. on Eastern time, that's when the data gets shut down for after hours. Nvidia was up nearly 1.7%. The initial burst was obviously traders wanting to get in and trying to take what they can, scalp, whatever. I think some of that could carry over into tomorrow for Nvidia, as long as the other macro factors don't mess it up, okay? Don't have a crystal ball, not right on everything. I don't like to play whether it's going to go up or down, or 5% or what. So we have that. Now, that is Nvidia. The chart here in front of you is AMD. So let me go back to NVDA on the chart. The 180 area, total resistance. I don't see Nvidia breaking that. However, if Nvidia does get a short squeeze, get a bounce of some type tomorrow, it is possible that 178 to 181 is stiff resistance. Right now, though, Nvidia's got a little bit of a problem trying to break through 163. 163 right now is tough resistance for Nvidia. the after hours move for Nvidia took them from where they closed just back up to where they opened today. Not 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 that far. Obviously they had a big gap down this morning, so where they opened was already over 3% off from yesterday. So yeah, right now Nvidia's got this tough resistance right here at 163. If, and it's a big if, they break above that, 178 to 181 will be the absolute top for Nvidia. I think Nvidia can come right back down. I think a nice place for Nvidia is probably the 137, 138 zone. I think that would be a potential good drop for Nvidia. And remember, we do have this gap. It starts right at the lower end of the weekly expected move, which is at 147, and it goes all the way down to 141. So if Nvidia breaks below the lower end of the weekly expected move, which is this purple line right here, then it's got that gap that could close really fast, bringing Nvidia down to its 20-day moving average. So that's the two scenarios. If it goes up or if it goes down, those are the key areas that you want to watch. Okay. The news was pretty bad. Do you think it'll affect the market on the downside in the next 2 days overall? I think, again, there could be an initial pop, short squeeze type of deal for Nvidia. The zones that I talked about, if Nvidia can get above 163, then I think it has the chance to go to 178 to 181. But that will be it. That is stiff resistance there. If Nvidia cannot break above 163, then it's going to start headed down to the lower end of the weekly expected move, which is 147. Okay. And then if it does break 147, you've got a gap that needs to be filled from about 147 to 141. And then I think there's some decent support for Nvidia about 139. Okay. So those are the two potential routes and the price points or zones to watch for with Nvidia's move. Okay. All right. So that looks like all the questions on Nvidia there. So I'll jump into today. Now, today's action, and let me pull up the SPX, which is the ticker for the S&P 500. I use that over the SPY just because there's more money going through, higher volumes, and it's a better representation of the S&P 500 in my eyes. So basically, over the past 4 sessions since last Friday, we've really gone nowhere. The top of where we closed that last Thursday to where we closed that today, we've basically gone nowhere. we're back to where we started. But today's action did represent an important shift in terms of intermarket relationships. That's interesting. So over the past 10 months, we've seen a consistent inverse relationship between what in the SPY and the S&P 500? Rates and one more. What's the other one? The dollar. There has been an inverse relationship, especially between the 10-year and the rate of change and the dollar, ticker symbol DXY, Dixie for the dollar, and that rate of change. Inverse relationship. When the dollar comes down, guess what? Equities go up, especially the SPX and the SPY. But when the dollar goes up, what happens to the SPY and the SPX? They come down. And the stronger the move on the opposite end. So on one hand, risk assets on the other. Okay? This is what you might expect in an inflationary environment where let's call it the boogeyman, is higher inflation and higher rates, depressing future growth potential through the specter of future tightening in monetary policy. However, around that corner from such an environment lies a very different reality where markets start to believe in monetary policymakers and that they will be able to remain committed to their cause against inflation, to maintain their credibility. But that crusade poses a risk to what? Growth. Growth. It poses a risk to growth that supersedes the risk of further inflationary pressures. Now, the biggest signal one might see to spot this shift is stocks and bonds starting to correlate positively again. When the 10-year goes down, the SPX and the SPY go down too. When the 10-year goes up, the SPX and the SPY go up too. That positive correlation, not an inverse correlation like it has been in all of 2022. And to the downside, in reaction to positive economic data. Okay. Now, we saw that dynamic take shape today, Wednesday, this morning, in reaction to that pretty solid, better than expected retail sales data. But that data also stacks up against rising interest rates by the Fed, stubbornly high inflation, a reduced wealth effect, and job security concerns as more companies announce layoffs. Market participants showing concerns about a slowdown in discretionary spending in the coming months is also a problem. Both Target and Walmart acknowledged that consumers were pulling back on discretionary purchases. Then add in Micron. Micron is cutting its DRAM, D-R-A-M, and NAND, N-A-N-D, wafer starts by about 20%, saying that the market outlook for the calendar year of 2023 has recently weakened. We've been saying it for months. The first half of 2023 is going to be rough. Micron also said it's working towards additional CapEx cuts. All good indications that 2023 earnings estimates are likely still too high and that the economy faces troubled waters ahead. Yet, in the face of those more subtle facts, let's put it, sits stronger than expected retail sales data, which effectively chains the Fed to its current path. It can't take its foot off the accelerator. Seeing rates dive on that data suggests an increasing appreciation that the Fed policy overreach is set to push us towards the hard landing outcome, where stocks and rates move back into positive correlation and move down. We've also started to see the dollar retreat on hawkish Fed speak, another signal of this narrative. Earlier in the session, San Francisco President Daley, who is a 2024 FOMC voter who has not voted this year, can't vote next year, but can vote in 2024, said that the idea of the Fed pausing its rate hikes is not even on the table for discussion right now. And she thinks, just like I think, a 5% Fed funds rate is a reasonable level where the Fed can hold rates. I think the Fed is going to 5%. No doubt. The Fed funds rate, 5%. And then the Fed can hold it at 5%. And the biggest decision on how this is going to work out is how long does the Fed hold it at 5%? A month? 3 months? 6 months? A whole year? That'll damage growth, holding interest rates that high. Now, later in the day, Fed Governor Waller, who is an FOMC voter right now, said that he's more comfortable stepping down to a, wait for it, 50 basis point hike at the December FOMC meeting following the economic data released from the last few weeks. Okay, so market participants would be wise to appreciate this shift. Intermarket changes happen from time to time. And being late to the game and recognizing this is a risk to performance. Okay. So it looks like at the December FOMC meeting, maybe we get the Fed lifting their foot off that gas pedal ever so slightly, bringing us that 50 basis point rate hike. But only if the data remains good. Now, I'm not going to let the positive PPI data this week or CPI data from last week rug pull me. I'm going to be on the lookout, because who's to say that inflation is over? Or better yet, who's to say inflation's going to go down to the 2% target? What if inflation doesn't? What if inflation only goes down to match that of the Fed funds rate and then holds there? If the Fed goes up to 5%, inflation comes down to 5%, and then it holds there, oh my goodness. What can the Fed do then? The only thing they'll be able to do, wreck growth, wreck the markets, raise rates to try to get to that 2%. So my big thing with inflation and the Fed is that I don't think it's going to come down to that 2% target. Inflation is becoming very sticky, and we see it in earnings reports across the board. So how low will inflation actually go? Let me know your thoughts. What do you think? Will it go down to that 2% target in 2023? Maybe 2024? Or will it go down to either match the Fed funds rate? If the Fed gets to 5%, maybe inflation comes down to 5% and holds there. Or will it drop lower, maybe to 4%? Let me know. All right, I saw your comments there, but I didn't want to lose my train of thought. Let's see what you guys had to say here. Do you think Head and Shoulders? Wait a second. I don't think I went up far enough. Okay. I think this is it, and then I'll work my way down. Doesn't this just imply that tightening will have to be even worse, given how consumers are still spending regardless? But what are consumers using to spend? That is the question. The last credit card report that we got showed that credit card spending went up. To me, that says consumers are using credit cards to pay for their current lifestyle instead of adjusting that lifestyle to bringing it down to their pay. What do you think about that? That's what I would say. Now, tightening, it's still continuing. $90+ billion coming off the Fed's balance sheet. That's money being sucked out sucked out of the markets. It's been doing that since September at that 90 billion pace. Let's see here. Do you see a head and shoulders pattern on the SPX or SPY have formed? You could look at that and say, sure, you could. But to break that neckline, you're going to have to come down pretty far, right? You're going to have to come down and retest these lows. But I do see an inverted head and shoulders pattern. And if you're looking for it, you can kind of go, oh, of course, my highlighter doesn't want to work. You can kind of go like this, like this, like this, and get that head and shoulders. My Sharpies are not perfectly cupping that head and shoulder. Let's see. My apologies. I drew the line on the wrong side. Let's take that off. Let's redo this. Okay. So, yes, I do see that I've seen others talk about it too, and I can see it also. A potential inverted head and shoulders pattern taking place here. My lines aren't perfect, but that at least gives you an idea of where to line it up. Yeah, that is true. But then where are we going to go with that? Do you think now is the time to be bullish in this market? Now, we've just come off an excellent run, okay? But what I'm looking at most, and let me adjust this chart because I want to show you real quick, and I want to get to all these other comments too. So if we look at the major trend line for 2022, right, which is starting at the top in January, we tag it again right there in April. Right here in April. And then we tag it again in mid-August. Well, we're coming up to that level right now. Somewhere between 40.50, 41.15 in that zone, depending on time, when how long it takes us to get there. So, yeah, we could get to that point, but then get rejected right there. And I would put my probability of being rejected here higher than a breakthrough, because the market, the economy, my apologies, the economy, it's still too weak, and it is still weakening. Okay, the first half of next year, I think we can get it can be just as bad as this year. But the second half, I'm optimistic about, at least right now with what I'm seeing. So I kind of answered your question and then just added on to it there a little bit. All right, let's clean this up a little bit. There we go. Let's see here. Doubtful inflation will reignite if they slow down, and stocks will like shit to the moon, which implies loosened conditions. I don't think that, at least from now until halfway through 2023, I don't think the Fed comes close or even signaling that they're going to start easing again and lower rates. I'm just trying to think through what would that look like with the economy and jobs and everything else involved with it to cause the Fed to do a true pivot like that. It would take a lot, and I'm just not seeing the economy holding up enough. Obviously, if it gets too bad, then yes, I can see your point. The Fed will need to do something. You do raise a good point. I'll give it to you. You do raise a good point. But I just don't see that happening yet. Okay? And I don't think that it's going to happen in 2022. And I've said this for months now. The Fed will not pivot in 2022, period. I don't think it's going to at all. Now, the Fed can slow down, go from 75, like it's been doing the past several FOMC meetings, to 50 basis points in December. I can see that. Leave tightening alone, just like it is. And then as we get into 2023, I think Q1, Q2, they're going to be rough. Then as we get into Q2, halfway down the road in 2023, then maybe the Fed starts to think about it a little bit more. But I think we're going to get a hard landing, not a soft landing, which means the Fed is going to over tighten, causing a hit to the economy. I think that's the likely how things are going to play out. I bet. Okay. Yeah, that's great. Yeah, let's see here. Yeah, I hear CEOs raising the price of goods left and right. Oh, yep. Because that's sticky inflation. Also saying how it's their second and third time raising prices. Yeah. Inflation is sticky. And right now it is tough to get rid of. And that's why I'm curious about the thought that what if inflation does not go down to the 2% target? What if it only goes down to 5% to match the Fed funds rate, or 4%? What if that's the outcome? It's just too sticky and won't go down anymore. But then you do have the argument, we are seeing some disinflation right now. So what if it goes past the 2% and goes lower? But I just think inflation right now is too sticky. Maybe in 6 months from now, maybe. I don't think 3 months from now, but let's just say it. What if 3 months from now? But I just think right now it's too sticky. Flash in the pan. If they don't hit 2.5% by a certain time span, they will lose. They have already lost credibility on inflation, my friend. I do not think the Fed has credibility on inflation. They were late to the game. They didn't start raising rates soon enough. They didn't start tightening soon enough. The Fed, in my book, lost credibility. The Fed lost credibility last year when they didn't act when they should have acted. If the Fed would have acted, even call it November or even December of last year. And remember, when we got the Fed notes for the December meeting, they were already discussing it and talking about it, but they didn't step in time. And that's caused a big problem. It's going to be tough to get rid of. So they lose credibility and inflation becomes entrenched. There is a time limit. I don't know when, guessing by March. March, that's the cutoff for Q1. That's the beginning of Q2. That's when things could start to get interesting. And maybe we start to get some deeper conversations with the Fed about what the Fed could be doing. Let's see here. Let's go over here. In my opinion, until inflation comes down to 4%, I am not positive on the market. Me either. Which company can invest aggressively in this environment? None of them until they see new money. Very true. Good point right there. Real good point. Flash in the pan. Let's see here. I was ready to scream at them a year ago regarding inflation. Credibility is long gone. Yes, it is. Absolutely. Their credibility is lost, and they are not only fighting inflation, but they are fighting to get some kind of credibility back. That's why they went 75, 75, 75, raising these interest rates at such a fast rate. That rate of change has been huge. And it may, I think, lead us to a hard landing and hurt the economy, which in turn then hurts us all. So we have to prepare for it. We have to be ready. But absolutely true. Yes, sir. True indeed. Let's see here. And I think I'm caught up. Screw it. I love Jerome for giving us another shot for the long term. LOL. Let's see here. I was a week away from buying the very top of the market. Oh, wow. Coming close. For the indices, that's in January. For some, that was November. So somewhere between those few months there. Okay, so as far as the important points go, there's only nothing's changed. We have the exact same points on the SPX and the SPY, the Q, the DIA, and the IWM. All of those major indices, all the levels that I've talked about for 2 days in a row are still the same. Not much has changed, but let's go through it here real quick. For the SPX, 4,000, that's it. That's it. It is very tough resistance. If somehow this rally gets a shot in the arm, it gets more momentum, then we got to go and face the 200-day moving average, which it did get kind of close to yesterday, intraday, which is right about 40.72, and then all the way up right now to about 41.15. That would be the top, I think, that this rally could go to. 415 being the top at this moment in time. The more time moves along, the lower that topping point will be. Okay, so right now the market could be making a topping pattern here. It's possible, if just say for fun, if we get another leg down tomorrow, that brings us down, I don't know, close to the weekly expected move, which is right at 38.94. And then Friday we gap down, then that would have been, or that would have created an island topping pattern right here, which was the same topping pattern we had in middle of August for the summer rally. So that could be setting up. No guarantees, of course, but that could be setting up. It's still, the SPX has not engaged that 5-day EMA yet. This marks, let's see, 1, 2, 3, 4 days in a row now. That's just crazy. Now, I want to go to the 5-minute chart because I want to show you something. If you're intraday trading, I want to show you this right quick. It's something very useful. And I used it yesterday. I used it today. And it's really good. All right. So the anchored VWAP. So on the chart, we've got this black line right here. Now, you open it, you anchor it to big news events. You anchor it to significant highs or significant lows. And it shows you that if price is below, that means people are underwater. I'm sorry, yeah, if price is above the line, then people are above water. Well, yesterday I anchored this to when the news came out about Russia, okay? And let me get my highlighter, which is right about here, okay? When that news came out, right about 1 o'clock. So it's anchored right here on the 5-minute chart to the 105 or 1305 candle, right? So then the market sold off, it reached this bottom, and then it came back up to where this black line is, and this black line right now, it came down like this and then went like this, okay, for yesterday. So once it came down and it tagged the previous day's low, all right, the previous day's low was right here. That's as far as it went yesterday on that bad news. And surprisingly, that's as far as it went today. That's a bullish sign, at least in the very short term. But anyways, once it turned around and bounced and it got back above this anchored VWAP to that big news, it back tested and then it rallied, okay? This would have been a good place to get in. When we break back above that anchored VWAP, it back tests and then you can ride it out. That's a good strategy. Today, if you were doing things a little bit different, let me clean the chart up here a little bit. That trend line, it was going down all day. And price, for the most part, was going down most of the day. All right, that's cleaned up enough for now. So let's open this up to just today. So still, leaving that anchored VWAP on from the big news event yesterday, we get this point right here. This is the trend line for the anchored VWAP. And if you'll notice a couple things here. Number one, when we gapped down this morning, we gapped down right underneath that anchored VWAP, okay? And then we sell off until we reach nearly to the previous day's low, and then we rally back up from that point and we hit the anchored VWAP from yesterday's big news, and then we sell off from that point again, going down to yesterday's low. This is a great tool to use, and this is how you can use it going long, or like today, using it for shorting, or even you could have used it from mid-morning here when it got real close to yesterday's low, riding it back up until it hit that anchored VWAP. So it's a good strategy to use when you're trading daily, okay, or just trading on 5-minute, 10-minute, 1-minute, whatever short frame trading you are doing, okay. Just trying to clean the chart up here a little bit. Now, you can also use the anchored VWAP like I do on the daily view, okay, for big major events like CPI day, FOMC rate decision day. I will put those anchored VWAPs on those big news event days and let it ride, okay? And you can see there's quite a bit of a convergence. Let me raise the chart up here a little bit. With all of the FOMC, CPI, there's a lot of converging happening right here. You can see a bunch of the black lines collecting right here, okay? A whole bunch of them are collecting right here. This is kind of that break-even point for a lot of people. Now, the most recent big news as far as the market goes, either data or the Fed, not news like Russia or something like that, it's coming up like this, okay? So it's just under that weekly expected move, and it's kind of lining right up with when Thursday gapped up. When it opened, this is where it opened, and it almost lines up perfectly to the most recent anchored VWAP, okay? So if, for example, if the market does break through the weekly expected move, which is at 38.94, we have to be careful that if the market starts sinking and it gets down to 38.61, there's a big gap right there that could be filled, and it could be filled awfully quickly, okay? So just keep that in mind. All right. Let's see here. Excellent explanation. Let's pull it up first so everyone can see. I always jump ahead of that. Excellent explanation around the positive correlation. Thanks. You are very welcome. Absolutely. All right, let me go to the SPY, and then I'll go to the Q, DIA, and the IWM. And also, there's a correlation between the HGY, which are long-term bonds, to the SPY, which some people call the smart money and dumb money, whatever the case may be. I trade in the dumb money anyways, so it doesn't bother me. But we can talk about that too, because there's some things happening that look like, well, maybe this rally could be over and we could be topping. All right. So everything I said about the SPX on the SPY, it's the same, just the numbers are slightly different. Instead of 4,000, it's 400. Okay. 400 on the SPY, very tough resistance. If the SPY, if this rally is going to go higher, then the 200-day moving average is going to come into play. That's at 406 right now. And then we also have the 2022 trend line that has stopped every major rally in its tracks. And that is currently sitting at, well, if we go to today, that's currently sitting right around 409. So between 406 and 409, that's where we have the 200-day moving average and the stop all rallies in 2022 downward trending trend line, that's in that zone there. So that'll be very stiff resistance. I don't think the SPY will have the momentum to break through that. And if it does, right above it is a Fibonacci level currently sitting at 414. Again, that'll be tough to break through. Now, on the downside, we've got the lower end of the weekly expected move at 388. 388 is a very sticky number for the SPY. It has been resistance. It has been support. It's been all over the place, okay? If we look, when we gapped up last Thursday, opened real close. As a matter of fact, we opened 388, all right? That's the lower end of the weekly expected move. We also have resistance right here, 388. Resistance, 388. Support, 388. So it's a very sticky number, okay? So be careful. If we go down, watch for that to potentially act as support. All right. Cleaning the chart up here a bit. Okay, let's go to the Qs. And again, very similar, but slightly different. We've got very similar pattern as far as candles go, but where the Qs are, we said this on Monday, this could be a support area for the Qs, all right? And it's right around 285. Where do we close? 285. This could be a support level for the Qs. It is the 38.2% Fibonacci retracement. You got that. You also have, it's very sticky. Right here, resistance at 285. Right here, resistance, 285. And then you had support right here, 285. So just like on the SPY, with its 388, on the Qs, you've got very very sticky 285 here to deal with. If we do break down below that, the weekly expected move is at 278, and there is a gap to be filled right below that. However, all of these anchored VWAPs, they're all converging right here around 274. So that could be a big support area for the Qs if they fall off. Now, with the Qs, a lot of technology, XLK. Let me look at XLK real quick, and then we'll do the DIA and the IWM. Okay? And I forgot that this was up on the screen. Let's clear this up. Now, if we look here, obviously a similar pattern to the Qs, especially with the candles, but we've hit resistance here and we're bumping our heads against the wall. You can go back here and see that as well. Now, we are outside. Are we really? Hold on a second. Hold on one quick second. Give me one quick second. The weekly expected moves were not updated. So I'm going to update them right now. And remember, you can get these weekly expected moves. I send them out to our investor community every Sunday evening. There's over 40 different products we do weekly expected moves for. Technology XLK, it is 137.64. That's where the top line should be. And then the bottom line for the weekly expected move, let's see, XLK, it's 128.64. That's the lower end of the weekly expected move. Okay. All right, don't need that anymore. Now that we've got them up here on the chart, it's updated. All right, so basically, we're right in the middle of the weekly expected move. We did reconnect with the 5-day EMA, or at least came really, really close to it. It looks like we connected with it, which is a really good thing. The lower end of the weekly expected move is 128. The upper end is 137. I think we're going to start heading down from here. And we can find support at that level because there's a lot of reactions along the 128 level for the XLK, the technology sector. But it is getting a little bit on the overextended side. We'll leave it at that. All right, let's go to DIA, which is the ticker symbol for the Dow Jones. I've said it. This thing is at resistance. And if you're looking for something to short, this could potentially be a good candidate, right? It's run up to very stiff resistance. I mean, as a matter of fact, it is really close. It's the closest of all of the major indices of breaking its summer rally or mid-August high. Now, all year, we've been making lower high after lower high, lower low after lower low. Well, if the DIA were to break above this point, 143, then it would no longer be making a lower high. It would be making a higher high. So this is a big, big resistance, I think, for the Dow Jones, ticker symbol DIA. The lower end of the weekly expected move is at 330, which has been sticky, okay? It's got a lot of reaction points along it, support, resistance, and there's a Fibonacci 78.6%, which is right at 331. So that could be support for the DIA in the short term. All right, IWM, and then we'll wrap this up. Again, if you have any other questions, now's a great time to plug them in so we can go over them. All right, looking at the IWM, this thing today, it fell right back down below its trend line that has captured all the major tops of 2022. And I'll give it to the IWM. These are your small caps. They tried their hardest to break above and stay above, but that candle, it told us yesterday that no, this thing's not going to stay up there. It's coming down. It did come down. A few of you did do some shorts on the IWM because we talked about it earlier in the week. Hopefully you kept those open, let it run today, and maybe you took some profit off the table today because of that. So congratulations to you if you did. Now, we could be making a topping pattern here. We've got stiff resistance. We've got the 200-day moving average, which we now have closed back under. We've got the down-sloping trend line that has captured all the major tops in 2022. And we've got the 61.8 Fibonacci retracement level. So we've got those 3 points right there lining up, telling the IWM, hey, you've ran too far, too fast. You need to pull back now. Okay. So look for consolidation, maybe slightly going down for the month of November for the majority of these products. Okay. And just to point out, do I have it here? Yes. Remember the seasonality chart. November right here. All right. What are we looking for in November? We're looking for consolidation to moving down. But at least going back, using the data all the way back to 1946 in midterm election years, November has not undercut the October low. And this thing has been spot on, capturing all of the major lows throughout all of 2022. So we're looking for consolidation, maybe down sloping before December, and we get our rally into the close of the year. All right. So that's what we're looking for. And that's what I think we're setting up to do. Consolidation, down sloping over the next couple of weeks, bobbing around, bouncing around, really tough to trade. But if you can find the rhythm of it, and hopefully we can point that out, then you can set up a few swing trades or day trades with that. All right, that is everything I had on my notes today. If you could, click that like button, share this video with a friend. Those two things help out tremendously. And I would greatly appreciate it if you could do that. And if you like the perspective and you want more, consider clicking the first link in the description. I think you'll love it. It's knowledge for investors, knowledge for traders to help make you better. All right. Everyone, thank you so very much for joining me this evening. I greatly appreciate it. You are totally awesome. I'm glad you're here. Really, I am. I'm still short coin till it's at zero. Yeah. Yeah. There's pain to come still in the crypto market. The FTX deal has been bad. It's been bad for the entire crypto space. But I have not given up on Bitcoin and Ethereum yet. The other altcoins, FTT, that showed us how they can just be created out of thin air, and then somebody else say they're worth something, and then they become worth billions. So the altcoins, they can stay off to the side. My focus is on Bitcoin and Ethereum. I think there is true there's true utilization of those, Bitcoin and Ethereum, I believe. Now, those altcoins, no way. So shorting coin, That's probably a good. Coin is CoinDesk for Coinbase for any that didn't remember. That's what the ticker coin is for. Okay, ladies and gentlemen, again, thank you so very much for joining me. I'll see you in the next video. You have a wonderful evening, and I'll be back tomorrow after the market is closed to talk about what happened, why it happened, and what to expect going forward. So have a wonderful evening. Good night.